Okay, so this is a real quick one. What about when there are summary financial statements and we are asked to report on those? So we're talking summary financial statements, less detail, not as heavy of all the material. So we would, just like some of the other things we've been talking about, we want to express an opinion on whether those summary financial statements are consistent with the big financial statement package that we have audited and that they've been derived from. Plain and simple. We need to have been the auditor who audited those. Otherwise, we have no business reporting on those summary financial statements, obviously, right? This is a separate engagement, and that's the only reason we would be able to accept that. We want to make sure that the regular audited financial statements are readily available if someone needed to get their hands on those. So yeah, and this one's kind of a good test question takeaway. If we're reporting on summary financial statements, we really only have two choices: unmodified or adverse. They're either good or not, right? They are either consistent or not consistent with the audited financial statements. There's no disclaiming that. There's no except fors that. You would just say, yep, it is, or nope, it isn't. So if the audited financial statements have an adverse or disclaimer, then we just say there's no engagement to report on these summary financial statements. We're going to withdraw from it because, yeah, it is a separate engagement. So that's that. Pretty quick and easy, right? There was one question, and it's a very basic. An auditor may report on, and they're calling them condensed financial statements. That's often what those will be referred to as. It's just not as much detail. It's just going to be very condensed into small, fewer line items, bigger chunks in those line items, right? So we're able to report on those if the auditor indicates whether the information in the condensed financial statements is consistent in all material respects. So that's what we're doing. It's kind of a basic question. Don't forget about these things, that we're trying to do with this type of thing, with supplementary information, with summary financial statements. We're looking for whether it is consistent with the audited financial statements, right? That's the thing we're looking for. So that's quick and easy. Interim financial statements. So we might be asked to report on interim financial statements, financial information covering a period of less than a fiscal year, right? So we're not going to do a full audit on this. It's essentially a review engagement. So we're going to do limited procedures, and it's going to essentially boil down to us saying whether we are aware of any material modifications that should have been made to the interim information, like a review engagement, which we haven't talked about yet, but that's the review report does that kind of language. You do limited procedures. It's way less in scope than an audit. And your report's not going to say it's presented fairly. It's going to say we're not aware of any modifications that need to be made. That's what we're doing with interim financial statements. The limited things we'll do before we issue exactly a review report is gain an understanding, analytical procedures, inquiries, read minutes, read the interim information, written representations, check with legal counsel, just those types of things we do in pretty much anything, right? So that is that. Questions on it? Should I have the things highlighted, but that's okay. Which of the following procedures should we ordinarily perform if we are conducting a review of interim financial information? Are we going to verify changes, inspect purchase order files, do cutoff tests? All that's too much. We are going to read minutes. these are good questions. Limited procedures, right? Which of the following statements is correct regarding a review of interim financial information? Why would D not be the answer? Why would we not be required to have sufficient knowledge of their business and their internal control? That's a very basic thing we need to do. Number 3, which of the following statements would not normally be included in a rep letter for review? So it would typically be the thing that's not true or not, it could be something that's like, there's no business telling them this. So we don't need them to say, we understand that a review consists principally of performing analytical procedures and making inquiries about the interim financial information. That's not something that would be in a rep letter. Things in a rep letter would be things like, we have made all the stuff available to you. We know our responsibilities about this thing. To the best of our knowledge, nothing has happened that would require you to adjust things. But they're not going to acknowledge in a rep letter that they understand what a review is, right? So good questions here. Reports on the specific application of some specific requirement. So we're reporting on a specific transaction. We're issuing a report about the appropriateness of them applying accounting principles. This would be probably for some certain specific person who wants to know this. So we would restrict the report that is solely intended for the people who need to know it. We would not ever accept any engagement involving a hypothetical transaction because that does not involve the facts or circumstances of the entity. And that's really about all we have to say about that. The questions, so this is just a very specific engagement here. There are only 2 here. While planning an engagement to issue a report, so we can attest to anything. We can, we're able to do that. So here we're attesting on a specific thing here. While planning engagement to issue a report on the application of the requirements of an applicable financial reporting framework to a specific transaction, a reporting accountant should obtain an understanding of what? Do we need an understanding of the financial expertise of those using our report? That would not be up to us to get that understanding. Do we need to know the risk appetite of the people who are involved in this? That's weird. Do we have to have an understanding of the form and substance of the specific transaction? Of course, right? It's a silly question. 2, in connection with the proposal to obtain a new client, an accountant in public practice is asked to prepare a written report on the application of accounting principles to a specific transaction. This should include a statement that any difference in the facts and circumstances or assumptions presented may change the report. So this kind of adds a little more information to the content, right? Seems, you could probably reason through this. But, without a little reading, you might not have landed on that answer. But yeah, that would be one of the statements that kind of help them cover themselves. C, we can definitely throw out. And D would be a little heavy. And we don't have to say we're not having to say all this in B. Yeah, so this number 2 is kind of a question that if you've got something like this, it'd be a bit of a long shot, but you might could reason through it. And if not, you just missed one. You're not going to get them all right on the CPA exam, right? So that's a little tougher one without some deeper reading. But number 1 is something based, with our basis of knowledge, we could certainly reason through number 1. 2 is a little harder to reason through without specifically reading a little deeper into this content area. But you can't just get a deep knowledge of every little nitpicky thing, right? You just have to get to the point where you can reasonably answer these things. That's kind of the key to success on CPA exam, is being, having a strong enough background knowledge on things to be able to apply what you know to any of these specific little weird areas. This one, number 2, is just a little too specific to be easy to reason through. So auditing, financial statements that are not GAAP financial statements, right? So some companies might prepare their financial statements not in accordance with GAAP. And you're like, what in the world? How could they do such a thing, right? So some, like small private companies, they're not publicly traded or anything like that. GAAP's time consuming. Y'all know this. Y'all been spending years learning the stuff. It's time consuming and it's expensive. And these smaller companies, there's no real maybe benefit to them accounting in accordance with that. I'll give you an example. I have a wife that has a optometry practice, and I am the accountant. And I sure as heck don't go through there doing everything GAAP. I'm not, I am not doing, I'm pretty much strictly cash basis the way I'm doing it. I'm not worried about what their receivables are. I'm not worried about what their payables are. I don't care. And she doesn't care. I mean, if she wants to know, the computer can tell her. And for that matter, I could get in there and look it up and hope the computer's right. But we don't need, every now and then a bank might say, I need a financial statement. Then I'll be like, all right, tell me what your payables are. And I'll put a little balance sheet together that's probably mostly right. But no, I don't do GAAP accounting and all that mess. It's just pure cash basis. That's what I do. And nobody's using that stuff except for me. And there's no reason for me to go through the trouble of doing the GAAP thing. So I don't get an audit. I don't have a need for an audit. But if I was doing like a business, if I own like a business in a small town, a small business like that, I would, and maybe someday I had the intention of selling it or something, then I might have a reason to start preparing more legitimate financial statements and maybe getting a local firm to audit those or something, just so, here are some audited financial statements of the business that we're trying to sell to you. That might be important to them, right? But no, I'm all cash basis on that. I don't care to do the GAAP stuff. So yeah, companies that are smaller, privately held, may not want to go through the whole time-consuming expense and whatnot of making nice, fancy GAAP statements. They may do a cash basis or a tax basis, right? They would have financial statements that are pretty much following the tax law, and those would look way different than a GAAP financial statement, or some other regulatory basis, or some contractual basis, or whatever. So what if we're auditing that type of thing? So we would want to make sure, kind of some obvious things, really. You would see a test question on this and you'd be like, well, yeah. So, is the financial statement appropriately titled? Is there it'd be very important to have a summary of the accounting policies they're following. And it would be important to have a description of how these financial statements, this framework, differs from GAAP. We want to be informative and not misleading. That's pretty much what it boils down to, right? So we'd want to have a better, an appropriate title for it. We'd want to have a nice description of the policies of accounting that we're following, and then a nice description of, hey, if you're looking at this, these are not GAAP. Here's how we differ from GAAP, because we don't want to be misleading to you. That's the type of thing we would want to consider. Management's responsible for doing those things. We're responsible for making sure it happened that way, right? In our report, we would want a emphasis of matter paragraph that we would title Basis of Accounting or something like that. And then a little throwback to last week where we mentioned that if there was a financial statement prepared on a restricted use a regulatory basis or a contractual basis, then we would need an other matter paragraph that specifically restricts its use, right? We don't want anybody else relying on that. That's not for them. It's for whoever that contract is with or that kind of thing. So pretty simple stuff. The report should, specific things that may not be as obvious, and I highlighted those in green. Also highlighted them green because I feel like test questions would probably zone in on these things at the bottom here. In our report, we should refer to a note in the financial statements that describes the framework that's being used. We want to specifically refer them to that. We want to make sure and state that the framework being used is a basis of accounting other than GAAP. And then we would, of course, have our opinion, and our opinion would be whether the financial statements are prepared in accordance with, not GAAP, but in accordance with whatever, right? So fairly straightforward, really, stuff. And they do give us several questions on it. How many we got here? They gave us 7. I thought they were mostly all pretty decent questions for such a small topic area. Number 1, when reporting on financial statements prepared on the same basis of accounting used for income tax purposes, the auditor should include in the report a paragraph that what? And even if you don't specifically maybe know the answer off the top of your head for something like this, you can easily kind of reason through, would I do this? Would I not do this? Would I want to have a paragraph that emphasizes that the financial statements are not intended to have been examined in accordance with generally accepted auditing standards? No, we're going to still follow the generally accepted auditing standards, right? We're auditing these things. Do I want to refer to the authoritative pronouncements that explain the income tax basis of accounting being used? Pay attention to the words. We don't need to refer to the authoritative pronouncements that would explain this basis. I don't even know where we would find such a thing. Management would discuss in the notes kind of what's going on with this basis of accounting, as we mentioned, and we would refer to that in the notes, but we're not going to say, hey, check out whatever, where it explains what this is. So no, B's a little too far. C says we would have a paragraph that states that the income tax basis of accounting is a basis of accounting other than GAAP. That's exactly what we do, right? That's exactly what we want to do. Do we want to justify the use of it? Not in the report, no. Do not. All right. Okay. Questions on that one? That was a pretty good little question. About number 3. Which of the following items should be included in the auditor's report for financial statements prepared using a special purpose framework? So yeah, notice the lingo they're using here. Here they're calling it a special purpose framework. Up here they said it's a basis used for tax purposes. So they may call this different things. So just be aware of that. 3 says, which of the following should be included in the auditor's report? A says a sentence stating that the auditor is responsible for the financial statements. If y'all answer that, y'all need to drop the course, right? The auditor is never responsible for the financial statements. That is management's responsibility, right? B says a title that includes the word independent. Kind of, that's the right answer, right? And this is not the kind of thing we're talking about right now. So it's kind of out of left field yet right now, but that's just kind of standard stuff that we do. We probably wouldn't automatically land on that without reading the others. We don't have the signature of the company controller on our auditor report, obviously. And we don't have a paragraph stating the audit was conducted in accordance with the special purpose framework. We don't, the financial statements were put together in accordance with that framework. The audits, you don't conduct an audit in accordance with a framework. It's in accordance with GAS, right? So this is a really easy question, but I feel like a question like this would probably throw some people for a loop. Maybe, I don't know. But yeah, it's quite easy. Number 4, Delta Life Insurance Company prepares its financial statements on an accounting basis that insurance companies use, pursuant to the rules of a state insurance commission. If Wall CPA, Delta's auditor, discovers that the statements are not suitably titled, Wall should what? So we mentioned in the notes that that's one of the things the auditor wants to make sure is that there's a good, suitable, not misleading title, right? So if we, the auditors, say that ain't good, then what would we do? So do we disclose our reservations in an explanatory paragraph and qualify the opinion? Do we apply to the State Insurance Commission for an advisory opinion? Do we issue a special statutory basis report that clearly disclaims an opinion? Or do we explain in the notes to the financial statements the terminology used? All right, so this is one of those types of questions. It's like you don't memorize and learn a question like this. You just get it and reason through it. So, if I'm reading that and I see that we are the auditor and the financial statements are not suitably titled, my automatic thought is I'm going to get them to suitably title it, right? That's kind of what I'm going to do as an auditor. I'm going to be like, look, this needs to be changed. Well, that's not one of our possibilities, right? So I guess that leads us down the path of, okay, it is what it is and it's not being changed. Then what do we do? Well, then we've got kind of I can't call it a gap problem because we're not in accordance with gap, but it's it's the equivalent of a gap problem, right? So what do we do with that? We, if it's not pervasive to the whole, deal, we qualify the opinion, right? If it's like the financial statements are materially misstated, we would adverse opinion, right? But no, we would qualify the opinion. That's going to be the thing we're going to do. And wouldn't have known that we would have to do that in an explanatory paragraph, but I know that we're not going to apply to the State Insurance Commission for an opinion on it. And I know that we're not going to have a special statutory basis report that disclaims an opinion. Disclaiming an opinion means that we had a scope limitation essentially, right? And then I'm not going to explain in the notes the terminology used. That's not, I don't do that. I'm not management. I don't mess around with the notes. So this is just kind of a process of elimination, reason through it and come up with the best answer to something that we are not going to know the answer to, right? That's kind of what we have to do a lot of times. So put a little test taking strategy into play. But it's not a difficult one, mainly because the other 3 are easy to throw away, not because A is easy to land on. Number 5, when reporting on financial statements prepared on the same basis of accounting as that used for income tax purposes, the auditor should include in the report a paragraph that, I just had a thought, did I hit the record button? I did. Okay, good. All right. And I have no idea what I just read, so I got to reread it. When reporting on financial statements prepared on a tax basis, the auditor should include in the report a paragraph that what? A says that we are going to state that the income tax basis of accounting is a basis of accounting other than GAAP. That is one of our big takeaways from this chapter, is that's something we're going to do, right? So that's an easy one to land on. We don't have to justify it. We're not called upon to justify it in the report. Management's going to have to justify it to us. I guess. I mean, they can, they really have to, and they can report it however they want, and we can audit it. We're not going to emphasize that they are not intended to have been audited in accordance with GAS, and we're not going to refer to the authoritative pronouncements. This is kind of a same question as before. How about number 6? Which of the following titles would be considered suitable? We've had a question or two that talked about suitable titles. Which would be suitable for financial statements prepared on a cash basis? All right. So we haven't really talked about that, but we're not going to call it an income statement, because that would be similar to what we might title it for GAAP, right? Statement of operations could be a little misleading too, honestly, because you see that type of thing, that's not really describing what's going on, right? I see that and I'm still thinking, income statement, right? But if I see this, statement of revenues collected and expenses paid, I know what I'm seeing right there, right? I know that this is not a GAAP income statement. I know that it's just showing money collected, expenses paid. That would be a suitable title. So don't use the title of a GAAP financial statement or something that even looks like it. So that's a good question. These are good questions for this section. Kind of stop with that one though. Any questions about anything? Okay. Audits of just a single financial statement or an audit of a specific element or specific account. So this is just a little section that you just kind of have to read, and you're like, okay, now I know that. Didn't know it before, now I do. It's kind of but you kind of boil it down to, okay, that makes sense. I don't know if that makes sense what I just said, but just like when I read this section, I'm like, okay, there we go. Not much else to say other than that. These are just kind of a list of facts, right? So it kind of starts with, all right, we're talking about auditing single financial statements, but before we do, let's get this cleared up. If we're talking about an element on the, dealing with equity, then we're going to essentially have to audit the entire balance sheet. If we're going to report on an element based on income, we essentially need to audit the entire set of financial statements. So they kind of get that out of the way right there, because these types of things are, equity is assets minus liabilities, essentially, right? The residual, what's left over, right? So if you're trying to get at an equity item, you're going to have to get the assets cleared up and the liabilities cleared up, so you'll know what's left on equity, right? That only makes sense. If you're trying to report on some income element, you all know how everything's tied in, right? So you pretty much have to get the whole picture to make sure everything's cool with income. But other than that, you could report on a single element. So you might be engaged to audit a single financial statement or a specific element of a financial statement in connection with the audit of the complete set of financial statements. So if that's the case, this is just kind of a lot of, you could do this, you could do this, you could do this. If this happens, you might do this. It's just a whole bunch of what if type things. So with this first one, you are auditing, you're doing a complete audit, but you're engaged to audit a single element or a single financial statement as part of that. And that would just be a separate report and a separate opinion for each of those two individual engagements. So not a whole lot of big deal there. But then you get into a whole lot of what ifs. So you might have a modified opinion on the complete set of financial statements. If that modification is relevant to that specific element that you're engaged to audit, then you should issue an adverse opinion if the modification on the complete set of financial statements is a result of a material misstatement. Or you should issue a disclaimer of opinion on the specific element if the modification is a result of a scope limitation. Otherwise, you'd be back to doing this piecemeal opinion, which we said several weeks ago that you can't express a piecemeal opinion. So if there's a modified opinion on the complete set of financial statements relevant to that specific element, then it's going to either be adverse on the specific element or disclaimer. And let me just kind of mention this whole little section is not super duper important in my opinion. You know, it's like this is kind of out there. So, you know, I wouldn't expect to get hit hard on this stuff on the CPA exam. If there's a modified opinion on the complete set of financial statements, but you consider that it doesn't really affect the specific element, then you can issue an unmodified opinion on the specific element only if the opinion expressed in the report does not accompany any report containing an adverse opinion or disclaimer. You know, anytime there's an adverse opinion or disclaimer, you're kind of limited on doing anything else. You don't want to draw attention ever away from an adverse opinion or disclaimer opinion. And there's been several things we've mentioned this semester about don't do this at all if there's an adverse opinion or disclaimer. So that applies here too. And you can do an unmodified on the specific element only if that specific element isn't a major portion of that complete set of financial statements or not based on equity or income. So that takes us back to the beginning. So it's a weird little section. Single financial statement is a major portion of the complete set of financial statements. So you can't express an unmodified opinion on a single financial statement when an adverse opinion or disclaimer is expressed on the complete set. So that's something you probably would know because, again, you just don't want to draw attention away from that adverse opinion. You know, it's like, hey, adverse opinion on the financial statements, but this one's cool. You know, you wouldn't do that.
Like there's some fiddly accounts that have a statement.
Yeah.
That would be okay.
Yeah. But yeah, if you had an adverse opinion on the financial statements as a whole, but they wanted you to specifically attest to this little area, you wouldn't be like adverse opinion on the financial statements, but receivables is cool. You know, you wouldn't do that, even if it was true, because it draws the attention away from the adverse opinion or something like that. Yeah, you just don't do that. Let's see, did they have any? They had some really straightforward questions on this one. Certainly look at because there's only 3 of them. And the questions usually drive some of these. To me, it's not a difficult section, but it's kind of a wordy and it's like taking you all over the place and giving you all these long what ifs. It's like, what is all this? But reading the questions sometimes kind of gets your mind right again, or it does for me. Number 1 says, as a condition of obtaining a loan from the bank, we need to submit an audited balance sheet, but they don't really want the related statements of income, retained earnings, or cash flows. We would like to engage a CPA to audit only the balance sheet. Under these circumstances, the CPA, what? A says, may not audit only the balance sheet if the amount of the loan is material to the financial statements taken as a whole. B says, may not audit only the balance sheet if they are a non-issuer. C says they may audit only the balance sheet if we disclaim an opinion on the other financial statements. And then D says may audit only the balance sheet if access to the information underlying the basic financial statements is not limited. So reasoning through all of this, it's, first of all, if I'm reading this, my first thought is, yeah, I can audit only the balance sheet. That is okay. So I can throw out A and B, and then I can easily throw out C, because we know if I'm disclaiming an opinion on anything, I'm not going to really do anything else, right? So you kind of easily land on D by knowing that you can audit just the balance sheet. And then the rest of that makes sense, right? Obviously, we would need information to all the underlying basic financial statements, right?
You just claim an opinion on something if you don't actually look at it. Like on SEC, you just claim an opinion on the other, they actually have to look through it to say to be able to say they just claimed it. Is there any situation where they would do that?
So you would disclaim an opinion if you, so
Can't know because they can't.
yeah, you can't do that at all. But to answer your question, I mean, you can't just say, I'm disclaiming this opinion. You'd have to have a reason for it. Now, that reason may come into play before you look at the financial statements, because it's like, I can't do an opinion on this because all this isn't available for me. But realistically, you would have ended up looking at it, all the stuff at some point, and gotten to the point where you said, I don't have the information I need to give an opinion on these financial statements because I don't have information related to this. So yeah, I guess the quick answer to your question is no, you wouldn't just throw out a disclaimer without looking at stuff. But yeah, with C, you can't disclaim an opinion on the other financial statements and really do anything else anyway, or an adverse opinion. So that's why C doesn't work. Number 2, an auditor is engaged to report on selected financial data that are included in a client prepared document containing audited financial statements. Under these circumstances, the report on the selected data should A, refer to the report issued on the audited financial statements. Can't imagine why it wouldn't work. B says be distributed only to senior management and the board of directors. C states that the presentation is a comprehensive basis of accounting other than GAAP. And D indicate that the data are not fairly stated in all material respects. So quickly and easily, you can throw out C and D. They're just kind of nonsense. So you kind of are between A and B. So again, we're engaged to report on selected financial data that are included with the financial statements we audited, right? So that's why we can kind of throw out C and D. So should the report on the selected data be distributed only to management and the board? What good would that be, right? So A means, or that means A would be our only really logical answer. We've audited the financial statements. Obviously, we should refer to that report. Why wouldn't we, right? 3 kind of says the same thing. And we'll move along. Not a heavy hit area, so I wouldn't worry too much about it. Look, no questions on the next one. So this is a quickie. Reporting on compliance with requirements of something. And this is a report as part of the financial statement audit. So we might, as auditors, be requested to also report on the entity's compliance with contracts or with regulations or something. And all this is being asked of us in connection with the audit we're already doing. What then? Well, we basically can do a lot of different things, whatever we feel like, honestly. We could combine our report with the report on the financial statements if we wanted to do that, or we could just do a separate report. So that's not really useful information as far as test questions go. We can do either thing. We would, and this would probably be a good test questions, the report on compliance would be restricted to specific users. That's a good little thing to maybe have as a takeaway. in a combined report, the communication about the compliance would be an other matter paragraph, and we would have an appropriate heading for it. But in our report, we'd have a statement that nothing came to our attention that would cause us to believe the entity failed to comply with things. And backing up, we would restrict that to whoever's part of the contract or whoever the regulatory agency is. Those would be the people who would care about this, right? Hey, look at that. You can't do any of this if you issued an adverse opinion or a disclaimer on the financial statements. So yeah, easy for everything. If you got an adverse opinion or disclaimer, stop doing things. Don't report anything else. That's pretty much it. Don't take away from the seriousness of the adverse or disclaimer. If you do identify non-compliance as part of this engagement to report on compliance, then we should describe that non-compliance. How about that? Even if they have a waiver for that non-compliance, we still need to include that it was non-compliance, and then we would probably go on to state that they had received a waiver on it. All very easy information here that I think we would be able to answer without having even read this, except for maybe that we would restrict our report on compliance to the specific users. That would be maybe the hardest thing to come up with without having read it. But quick and easy little section. No questions even given on this one. So we move along. Two more little sections here. All right, so we're doing an audit, and the company we're auditing uses some other organization to do stuff for them. For example, they might have some other company that processes their payroll and does all of that. Well, what if we're auditing a company that uses some other company to process their payroll? We're just going to be like, oh, well, we don't have to look at payroll then because somebody else is doing it. Obviously not, right? So that makes our job a little different, right? So we need to obviously still audit and make sure that payroll's fine, even though someone else is doing it, not the company, right? We're interested in the financial statements being fairly presented. I'm just using payroll as an example. You can have service organizations doing other things for you. But no, you don't just ignore it and say, yeah, they're obviously probably doing it right. So we got to check on things. So that's what this chapter is about. So this is a situation where an entity that we're auditing uses services of some service organization. For example, a company might process their payroll. So as with anything, we need to obtain an understanding of those services, and we need to figure out what the effect of those services is on internal control, and we need to perform some kind of procedure to respond to any risks that we have identified. So this would all be relevant if the service organization services affect really anything. It's a kind of a stupid sentence, but if it affects our client's information system related to financial reporting, or if it affects safeguarding assets. So really, if it affects our financial statements at all. So we needed a sufficient understanding of the service organization. Could be that some other auditor has audited that organization. So we might get a report. And there's two types of reports that we could get. One that's less and one that's more, right? So we got a type 1 report that's a little less. It reports on the adequacy of the management's description of the organization's system. And here's the difference, the suitability of the design of controls. So they're just reporting that, these are suitably designed. All right, type 2 goes further. It reports all of that, but also on how effective they operate. So type 2 is a little stronger. So we might get these reports and use those as audit evidence. And if we're doing that, obvious things again, we need to make sure that the auditor who's reporting that is competent. We need to make sure that the auditor that's reporting that is independent. And we need to make sure the auditor is following auditing standards, right? So kind of obvious stuff there. We could perform our own procedures. We would need to contact the service organization through the audit client. We don't just go off on our own and contact them. We could use another auditor to perform procedures. We can do a lot of different things. Bottom line is we need to be satisfied that everything's working the way it should at that service organization.
Was there ever be a situation where somebody on the audit team for one company was also auditing another company at the same time for that same service organization?
Say that again.
Like that, like you're auditing, you audit, we would consider both big, like if you were auditing UPS and FedEx, instead of both the AUD, do your payroll. And your,
Can you double down? And
yeah.
Because you wouldn't redo the audit. I mean, you might have to do a little bit additional as it pertains to that specific organization, but no, most of your evidence the first time still is good evidence. And, obviously, again, it's the auditor, you're assessing risk, and, your whole idea is, are these controls operating effectively? And if you've already assessed that as part of that audit, you're probably going to be satisfied that they're still working for whatever other company, because those are the controls in place and they should be designed the same. Yeah. So you wouldn't have to double up on the work. Okay. And so we're just looking for risks that things aren't working right. So we would respond to any risk. If we expect the service organization's controls are all cool, we would want to obtain a little bit of evidence about their effectiveness, and we could get that type 2 report, which attests to the effectiveness, or we could perform our own tests of controls at the organization itself ourselves, or get another auditor. And we can do a lot of different things. That's kind of what it boils down to. However we want to do it, as long as we get information about that service organization, it's fine, right? If our audit client outsources a big chunk of what they do to a service organization, then obviously a big portion of our evidence is going to be at the service organization. So we might have to, at that point, get in there and do our, everything we've said so far have just been tests of controls. We may at that point need to get into substantive procedures if there's a lot going on there, or have some other auditor do it on our behalf. So if we're unable to obtain sufficient evidence about the service organization, then it's a scope limitation like any other that would lead to either a qualified opinion or a disclaimer, depending on the pervasiveness of what they do. So a little overlap with our other sections coming up now. We wouldn't refer to a service company's auditor in our report that has an unmodified opinion. We don't want to divide responsibility with the service auditor. We may refer to the service company's auditor in our report if it has a modified opinion, but only if that reference would be relevant to understanding our modified opinion. So kind of some same old things that we've talked about as it pertains to other things. So that is it for that section. 4 questions, all quite straightforward in this section too. One says a client uses a service organization to process its payroll. Which of the following statements is correct regarding the user auditor's use of the service auditor's report? The hardest part about this is understanding what the heck they're asking. So the user auditor is going to be the auditor of the company that's using that service. Yeah, that's the hardest part, is like, what are they talking about? And then we got the auditor who audits the service company. All right, so which of the following statements is correct regarding the main auditor's use of the service auditor's report. So A says the client's auditor can use the service auditor's report to jointly determine the materiality level. No, right? We're obviously not going to do that. That is not at all what we're doing. B says the client's auditor can use the service auditor's report without inquiring. Just kind of stop there, right? Of course, we're going to inquire stuff about the reputation of the auditor. Obviously, we do that. C says the service auditor's report should be referred to in the report of the client's auditor. We just specifically said, no, we cannot do that. And then D better be right. D says the client's auditor can use the service auditor's report as audit evidence for the client's internal controls. That is exactly what we're doing, right? That right there, that sentence right there in a nutshell is that whole chapter. We are using a service auditor's report as audit evidence about what? Internal controls, right? So that is a good one. 2, green CPA is auditing the financial statement of Ajax. They use a service center, DP, to process its payroll. DP's financial statements are audited by Blue. Oh, goodness, this is getting confusing already, isn't it? Who recently issued a report on DP's policies and procedures regarding the processing of the entity's transactions. In considering whether Blue's report is satisfactory for Green's purposes. Whew.
Once it gets past like 3.
Huh?
Once it gets past like 3 names, it's not very
Yeah, it's hard to juggle all this. I feel like this is a question an author wrote. This is too much craziness here. But it's easy to answer because even if you don't follow the logic of what the heck's going on, is there ever a situation where we wouldn't want to make inquiries regarding their professional reputation? So that's the answer. What a crazy question, though. I don't see the need to look at any of these others. It's just more about referring in the report, or rather not referring to the other auditor in the report, that kind of thing. More of the same. So part 2 of this is the next chapter. So this one flips and says, what if we are the service auditor? You know, we're the ones auditing that service company, and the main auditor of someone else is calling upon us to attest to whether these controls are working or not. So that this chapter puts us in that position. So we may be engaged to issue one of those 2 reports that we just talked about. That could be an engagement where we're just reporting on whether the control policies and procedures are suitably designed and placed in operation. So that's the type 1 thing. Or we might be engaged to go a little further and also attest to whether they're working effectively. That would be a type 2. So this puts us into the attest engagement standards, which I don't guess we really talked about at this point, but we will. So this is an attestation engagement, not an audit. So we are attesting to this. You know, we're providing them with a report that attests to whether the control policies and procedures are suitably designed, placed in operations, and maybe even working effectively. So our procedures would be inquiries, inspections, the type of things you do when you're testing controls, because that's really all we're doing. We're just specifically reporting on those for someone. So inquiry, inspection, observation, written representations from management. If we're on a type 2 engagement about effectiveness, then we would go on to do deeper tests of controls at that point. With a type 1 report, we would specifically, and this is a good test question here, if we're just doing that type 1 report where we're just saying whether it's suitably designed and placed in operation, we would want to make sure and disclaim an opinion on operating effectiveness, right? We want to be not misleading, right? So we'd be like, designed well, in operation, haven't looked at the effectiveness of the operations. We're disclaiming an opinion on that. So our opinion would just state that the description of internal controls fairly presents the system that was designed and implemented, and that they are suitably designed to provide reasonable assurance that the control objectives would be achieved if the controls operated effectively. But then we're going to disclaim an opinion on whether they're operating effectively because we didn't test that. Type 2 would go with the same opinion that we just read, and then would go on to express an opinion that the controls did operate effectively. There would, in other words, not be a disclaimer of opinion on operating effectiveness. Pretty straightforward, right? So that's that. That's our last little chapter. But our questions here, thought, let's see. That 1, 2, and 3 weren't really worth looking at together. But I thought five might be the best one. Payroll data company processes payroll transactions for a retailer. Cook CPA is engaged to express an opinion on the description of the payroll company's internal controls that are placed in operation. These controls are relevant to the retailer's internal control. So that report may be useful in providing the retailer's independent auditor with information necessary to plan a financial statement audit. The report should what? So subtle wording here. Pay attention. Don't add your own words to this. All we're engaged to do is express an opinion on the description of the internal controls. That would make this a type 1 report where we're not going so far as to attest to the effectiveness of them. We're just have an opinion on whether they're suitably described, right? So if that's the case, we would have that disclaimer of opinion on operating effectiveness. So there you go. B is not something we would go as so far as to state, right? This says we would state whether those controls were suitably designed to achieve the retailer's objectives. We can't attest to that. We're not familiar with the retailer's objectives. So that would be a dangerous statement to make. Okay. That was the best question, I thought. And that gets us through week 11. Are there any questions about clapping? Yay. Any questions on any of that week 11 stuff?